Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Dell Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so let's just shake off the disclaimers and talk about a chart that, honestly, it practically broke my monitors on Friday.
Yeah, it was wild.
Because if you were watching the tickers on May 22nd, you saw this, just an absolutely violent repositioning of capital. We're talking about this explosive high-conviction breakout where the stock surged over 16% in a single day.
Right, closing right at $295.
Exactly.
And, that caps off a staggering 39% gain over just the past month, which, you have to understand, a 16% single-day move on a company of this massive size.
No, that's not retail traders playing with options.
No, not at all. That is institutional money violently backing up the truck, just aggressively repositioning their entire portfolios.
Right. And that really brings us to our core mission for today's deep dive. We need to figure out the actual mechanics driving that 39% climb. Like, is this just a short-term momentum spike, just a flash in the pan fueled by overall market enthusiasm? Or are we witnessing a fundamental structural re-rating here?
And just to clarify that Wall Street jargon for a second, a structural re-rating essentially means the market is waking up and realizing, hey, we've been pricing this company like a dying legacy dinosaur.
Yeah.
And now they suddenly have to price it like a cutting-edge artificial intelligence powerhouse.
That is the perfect way to phrase the central question.
Thanks.
To figure out if this is a permanent re-rating or just a hype bubble, we really have to peel back the narrative. We need to look at the actual balance sheet mechanics,
Exactly. We
Yeah.
need to see if the underlying business is actually transforming.
All right, let's move into the wealth building context. Because if we are going to look at this from a long-term, multi-year portfolio strategy, you basically have to completely shift your perspective.
Oh, totally. For the longest time, when you heard this company's name, you almost certainly pictured like legacy low-growth PC manufacturing.
Right. You pictured that beige desktop sitting in a 1990s cubicle.
Yeah, exactly. And that is the legacy hardware anchor that has weighed down their valuation for a literal decade. But to understand the wealth-building thesis today, you have to look past the laptops. You really have to view them as the premier enterprise proxy for the whole global AI infrastructure build-out.
Right. So forget the old pickaxes during a gold rush cliche for a second. Think of the current tech landscape this way. Traditional software is like buying a car. You can drive it on standard asphalt roads.
Right.
But artificial intelligence, these massive large language models, that is like buying a high-speed 3,000-ton freight train.
Oh, I like that analogy.
Yeah, because you cannot run a freight train on standard roads. You literally have to tear up the ground and lay down specialized heavy-duty steel tracks. In this analogy, the massive heat-generating, power-hungry physical data centers, those are the steel tracks. And this company isn't just selling the steel, They are laying down the entire track system so these models don't derail.
That is a brilliant way to visualize it, because the physical reality of artificial intelligence is brutal. It really is.
Yeah, it generates so much heat.
Exactly. You cannot run a cutting-edge AI model on legacy servers. They will literally melt.
Wow.
Yeah, it requires an entirely new, liquid-cooled, highly dense architecture. Everyone talks about the software, but none of it exists in the ether.
Right, the cloud is still physical computers.
Exactly. It all lives on physical racks, and they're the ones supplying the heavy machinery for this new data age.
Now let's look at the fundamentals, because look, you can have all the AI infrastructure narratives in the world, but if it doesn't show up on the balance sheet, it's just a story.
Just hype.
Right. Are these massive server orders actually translating into hard revenue? And the answer is yes. The scale is staggering. We are looking at a company generating $113.5 billion in annual revenue.
And what really matters there is how the composition of that revenue is shifting.
Right.
The engine pulling this train right now is their infrastructure solutions group. Specifically is the AI server demand. In their most recent quarter, they reported a record-breaking $34.1 billion in AI server orders.
Wait, let's pause on that number. 34.1 billion.
Yeah.
That is not forecasted demand, right? Those are actual orders.
Yes. That is an astonishing amount of capital expenditure being directed their way in just a 3-month window.
Wow.
And it leaves them exiting the fiscal year with a massive $43 billion AI backlog.
So 43 billion just sitting there waiting to be fulfilled.
Exactly. Now, a backlog is critical for investors because it provides incredible visibility. It means even if the economy slows down tomorrow, they have $43 billion of guaranteed work already in the pipeline.
Just waiting to be built and billed.
Right. That is how management is comfortably guiding for $50 billion in AI revenue for fiscal 2027, which, by the way, effectively doubles last year's figures.
That's insane.
And plus, even their traditional PC market is showing a cyclical recovery right now. If you look at the read-through from a peer like Lenovo, they just saw 24% PC growth, alongside an 84% surge in AI-related revenue.
Wait, hold on. I have to push back here for a second. You're throwing out $50 billion in AI revenue guidance, but historically, selling enterprise hardware is a brutal, margin-dilutive race to the bottom.
That's fair.
Like, I can go buy a server from anywhere. How is this company not just going to get completely undercut on price by cheaper overseas manufacturers? You can have $50 billion in revenue, but if your margins are razor thin, it doesn't translate to actual cash flow for investors.
So that is the billion-dollar question, literally.
Yeah.
And it comes down to understanding their specific competitive moat.
Okay.
They aren't just selling isolated boxes of hardware anymore. They have built what they call the Dell AI Factory with NVIDIA.
Dell AI Factory.
Right. It is an end-to-end integrated solution. They are combining the servers, the networking, and critically, their PowerStore Elite advanced storage into one seamless pre-configured stack.
Okay, explain that mechanism for me. Why does a pre-configured stack actually protect their profit margins?
It's because of the lock-in effect. When an enterprise buys the PowerStore Elite, it's not just a physical box of hard drives.
Right.
The storage is natively coded to talk directly and efficiently to NVIDIA's specific AI chips. So if an enterprise tries to switch to a cheaper competitor later on, like an HP or HPE, they don't just have to unscrew a physical box from the rack. They literally have to rewrite their entire data automation software. They have to retrain their IT staff and risk massive system downtime.
Oh, wow. So they're trapped, basically.
Basically,
Yeah.
That native software integration creates incredibly high switching costs. Fragmented competitors simply cannot match that depth of integrated architecture.
Yeah.
And that acts as a shield, protecting their margins from commoditization.
That brings us to the catalyst timeline, because we've established the historical fundamentals and we see how the technology protects their margins. But like, what is going to drive the stock next?
Right. What's the spark?
Exactly. What are we looking at in the immediate future?
Well, the most immediate event on the calendar is the fiscal Q1 2027 earnings report dropping on Thursday, May 28. Consensus is heavily leaning toward management raising their full-year guidance based on the sheer velocity of that server demand we just discussed.
Right.
And we also just had their massive Tech World event in May 2026. That served as a major driver for product momentum because they officially unveiled that PowerStore Elite architecture.
But here's where it gets really interesting to me. Beyond the specific earnings report, macro analysts are pointing to a massive, albeit speculative, macroeconomic catalyst hovering over this entire sector.
Yes. And to understand it, we have to zoom out and look at global geopolitics.
Right.
Analysts are closely monitoring the potential of an Iran nuclear deal. If a deal actually materializes, it could theoretically reopen the Strait of Hormuz to freer maritime traffic.
And let me just connect the dots for you on why a geopolitical maritime strait matters for an AI server company.
Please do.
Because data centers are essentially giant space heaters that do math.
Great way to put it.
They require gigawatts of electricity. If the Strait of Hormuz reopens, crude oil prices drop. Lower global energy costs directly translate to cooling down broad inflation metrics like the CPI. And if inflation cools, it forces the Federal Reserve into a dovish pivot, meaning they pause or even cut interest rates.
It is a profound economic domino effect.
Right.
Cheaper energy leads to lower inflation, which leads to cheaper borrowing costs. And since building a $500 million data center requires massive amounts of debt financing.
Yeah, nobody pays cash for a whole data center normally.
Exactly. Cheaper capital creates an immediate massive tailwind for more server orders.
Now let's pivot to the chart, because we have to ask how the market is physically trading this information right now. We mentioned that volume-backed breakout earlier. It closed at $295, and the 52-week high is sitting right there at $298.
Breaking that $298 level is critical from a technical perspective.
Why is that so important?
Because once a stock clears its 52-week high with this much momentum, there is virtually non-existent overhead resistance.
Oh, because everyone who bought previously is already in profit.
Exactly. So there are no trapped sellers waiting to dump their shares just to break even.
Right.
It sets a psychologically bullish stage for a rapid, frictionless move right into the $300 plus range.
Yeah.
It is blue sky territory.
And again, it wasn't a quiet drift upward, you know? That 16% single-day surge on Friday was initially triggered by Lenovo's strong peer earnings.
Yeah.
But it was confirmed by a massive institutional rotation.
Well,
The big money aggressively moved into the AI hardware trade. But, I mean, looking at the chart, it is practically vertical right now.
it is entirely vertical. It looks like a rocket launch.
Yeah, and that is exactly my concern. When a chart goes vertical, the floor often completely disappears beneath it. If management gives great earnings on May 28th, but it's not absolutely flawless, we could see a classic sell the news event where traders just lock in those 39% monthly gains.
Right.
So where does the structural support actually lie if this thing pulls back?
So a vertical chart does mean the immediate support levels are quite a bit lower.
Yeah.
If we see a pullback, the stock will likely retrace back near its previous consolidation zones from before the breakout even happened.
Ouch. That's a drop.
It is. That is the inherent risk of chasing a vertical extension. Your risk-to-reward ratio becomes temporarily skewed because the nearest technical floor is far below you.
So what does market sentiment look like? Because a breakout like that is clearly being fueled by an aggressively bullish shift in the Wall Street narrative.
The analyst community is in absolute overdrive right now. We are seeing massive sweeping revisions across the board.
Like what?
Well, Wells Fargo just drastically raised their price target from $180 all the way to $270.
Wow.
Morgan Stanley lifted their target from $110 to $170. And media sentiment is echoing all of this, flagging them alongside giants like ASML as top large-cap gainers.
Okay, I have to stop you there. Because look at those analyst numbers again. A target jumping from 180 to 270. That is a $90 increase in one swing. Are institutions just playing a desperate game of momentum catch-up here?
What do you mean?
It feels like they were asleep at the wheel, they completely missed the rally, and now they're just throwing out massive targets just to justify their late entries to their clients.
Look, it is a very valid critique.
Yeah.
When price targets are revised upward by 50% or more in a single stroke, it almost always reflects analysts adjusting their mathematical models to match the reality of the price action rather than actually predicting it.
Right, they're reacting, not forecasting.
However, it also signals something deeper, which is fundamental capitulation.
Capitulation.
Yeah, it means the last remaining skeptics on Wall Street are finally throwing in the towel. They are accepting that the hardware cycle is a structural, multi-year reality, not just a fleeting trend.
Now let's talk about the risks. We need to ground this conversation entirely. The momentum is fiercely bullish right now, but what could tear this entire thesis apart? Let's start with the valuation risk.
Right, because despite the breakout and the analyst capitulation, there are conservative valuation models out there that calculate the true fundamental fair value of the company at roughly $168.61.
168, that is a massive discrepancy from 295.
It is huge. If those discounted cash flow models are accurate, that implies a steep 43% downside from the current $295 level.
Yikes.
Yeah, that is the mathematical bear case staring you right in the face.
And then there is the macro risk. We talked about the bullish scenario of an Iran deal lowering rates, but what if the exact opposite happens?
Right.
Analysts are pointing to a scenario they are dubbing Trumpflation. We are currently looking at sticky inflation running at 3.8%. And according to the CME Group, the options market is pricing in a 77% probability of another interest rate hike by April 2027. If the Fed actually hikes rates again, borrowing gets far more expensive.
Which brings us back to our earlier point. If borrowing gets too expensive, it severely chokes off the debt-dependent financing required for enterprises to build these massive data centers.
Right.
A traditional economic view says higher rates equal lower capital expenditure.
But here is where we have to introduce a really fascinating counter-argument, and it's the concept of the corporate firewall.
Oh yeah, the corporate firewall.
In a normal cycle, yes, higher rates would crush hardware orders, but the companies buying the vast majority of these AI servers right now, they are the mega cap tech giants.
Right, your Microsofts, your Meta.
Exactly. They have absolute fortress balance sheets with tens of billions in cash on hand. They are entirely self-funding this AI arms race. They do not need to go to a bank to finance these purchases. So this corporate firewall effectively renders the AI hardware sector temporarily immune to standard Fed rate hikes.
That is such a crucial distinction.
Right, because they're going to buy the servers regardless of what the Fed does, because falling behind in artificial intelligence is a literal existential threat to their survival.
Right. The hyperscale demand we are seeing right now is non-discretionary. They are buying with cash, which insulates the supplier from broader macroeconomic rate shocks.
So with everything on the table, what's the final verdict?
Based on the research, we are looking at a bullish score of 8 out of 10.
Okay, 8 out of 10.
Yeah. The timeline view breaks down into two distinct phases. First, it is a high-conviction swing trade leading directly into the May 28 earnings report. Second, it transitions into a multi-year hold, but only if management officially raises their fiscal 2027 AI revenue guidance above that critical $50 billion mark.
So that's the trigger.
Exactly. That raised guidance is the confirmation needed to justify long-term compounding.
Before we wrap up, chew on this final thought. If this company is effectively becoming the physical landlord of the artificial intelligence revolution, building the servers everyone absolutely must have, what happens when space and power grids run out before the hardware does?
Oh, that's a scary thought.
Right. We are already seeing municipalities deny permits for new data centers because they drain local power grids. Are we currently pricing in a massive physical infrastructure bottleneck that no one on Wall Street is even talking about yet?
That's entirely possible.
It is definitely something to watch as this plays out. If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk. No indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.